Hello candidates and welcome to this masterclass on an introduction to financial statement analysis. My name's John Bone and I'll be your guide to this area. To be honest with you, I think there's lots of simple stuff here. There's nothing particularly complicated here, but stuff that nonetheless can be tested in the exam. So I'm going to try and get through this material fairly quick so we can spend longer on the more tricky and difficult areas that we're likely to encounter in the exam. Okay, so we're looking at an introduction to financial statement analysis. So what have we got for our exam? The purpose of financial statement analysis, and the CFA Institute seem to be very keen on us understanding the framework for financial statement analysis. Although I have to say, I look at that framework for financial statement analysis and I find it blindingly obvious. And if you work for a firm, they will have implemented something very similar anyway that governs how you work. We're going to look at sources of regulated information, so obviously that includes the financial statements themselves, but other sources of information such as regulatory filings. We're going to talk about the content of the audit report and what an audit report is, and I think that's probably one of the most important things in this particular area. And then we finish off this area looking at the differences between US GAAP and IFRS. And those differences are getting smaller and smaller and smaller over time as the two accounting standard bodies work on convergence. But we're not there yet, so there are differences. So let's talk about the scope of financial statement analysis. So this is the idea of using financial reports, income statements, balance sheets, cash flow statements, footnote disclosure, and other sources of information, external. So it could be journals, it could be company visits, it could be regulatory providers of information, etc. And combining this information to evaluate the company. Now, first of all, what we're going to do is evaluate how it's performed in the past. And what we're going to look at here is how it's performed in the past and its present situation compared to its stated objectives. Where do we find the stated objectives of a company? Well, a good place to look is in the management discussion and analysis, and we'll talk about that in a while. So is it achieving its goals? How is it performing? Now, of course, typically as an analyst, we're not necessarily interested in the past and present. What often we're interested in is the future. What future cash flows will the company generate? Does that make an investment look attractive? Does it make it look like their debt can be serviced, etc.? So what we're going to often be forecasting in the future is performance. And when we talk about the performance of a company, typically we're talking about the income statement. The position of the company, remember the current position of the company is given by its balance sheet. We look at assets minus liabilities, giving us equity. Remember, assets are everything the company owns and everything the company is owed. Liabilities equal amounts owed to third parties. So take the assets, deduct the liabilities, and anything left over, of course, belongs to the shareholders. And we talk about that as being the financial position of the company. But we're also interested in financial flexibility. This is looking at how companies can respond to unexpected adverse events, but also unexpected opportunities. And that's often a function of the cash the company has at its disposal. So we're going to be very interested in cash flow statements as well and forecasting those. And of course, we often use forecast cash flows to compute things like free cash flow to the firm, free cash flow to the equity holders as valuation techniques. Now, notice it says, really, we're looking at investment, credit, and other economic decisions. What they're really trying to say is financial statement analysis is not just looking at the shareholders, the current shareholders of the company. It goes well beyond that. It's really anybody that is thinking of investing or transacting with the company. So it could include, for example, when we're looking at investment, it could include on the buy side, fund managers that are considering including the company within their portfolios. On the sell side, of course, it could be equity analysts that are producing equity research reports and buy, sell, hold recommendations. It isn't just equity, of course. It's also looking at debt securities. So the credit rating agencies, when they're assigning a credit rating to a bond or a piece of debt. But also, of course, financial institutions like banks that are considering lending to the company and are trying to assess the credit worthiness of the company when establishing how should they lend, how much should they lend, and of course what interest rate to charge as well. Other economic decisions? Well, here we're going beyond just buying and selling debt and equity to looking at things like private equity transactions, where essentially private equity firms, rather than making an equity investment, are buying entire companies, of course, and trying to turn them around and then spin them off. So things like private equity, venture capital, things like mergers and acquisitions within corporate finance as well. I think it's worth being aware of the 6 stages of the financial statement and analysis framework. I've listed them out here. As I said, I find this framework is pretty obvious, really. Nonetheless, I think you need to know what the 6 stages are. I think typically the way this might be examined is they give you an activity, i.e. some behaviour that somebody is doing, and they say, what step of the framework does this fit into? So step 1 is articulating the purpose of your financial statement analysis. What are you trying to achieve? Are you trying to produce equity research and buy, sell, hold recommendations? Are you trying to issue a bond rating, a credit rating for a bond? So we set out the purpose of the analysis, and then also the content. What are we going to be producing? What are we going to be producing in our research report or on our credit rating report? Okay, so the output, if you like. Step 2 is collecting data, and of course that includes the financial statements, but it goes way beyond the financial statements. Any other data that we think is going to be useful. Trade journals, filings from the regulatory agencies, company visits, going to site visits and discussing things with managers and key employees. So we're going to collect all our data. We're then going to process the data. So that includes producing charts, graphs, and in particular, I think I'll add this to it, computing ratios. Okay. Now, after we've done that, very key point, we've got to analyze the data. What is this data telling us? So we produced a bunch of ratios, but what do they mean? So again, we need some context for this. We're going to need to look at the ratios. We're going to need to look at the ratios we've calculated. We're going to need to compare them to the stated objectives and strategy of the company. And as I said, management discussion and analysis is a good place to identify that. So analyze the data. What is it telling us? Then move to step 5, make your conclusions. So if it's an equity analyst report, is it a buy recommendation? Is it a sell recommendation? Is it a hold recommendation? If it's a credit rating, what are we going to attach? What credit rating is going to be attached? And of course, we make our conclusions and recommendations at this step. And then finally, last step is continuous follow-up. The idea is, of course, we live in a dynamic world which is continuously changing, and therefore, of course, we need to update our analysis if it goes out of date or if significant new information comes to light. Okay, so just be a little bit aware of that framework. I'm not expecting it to cause you any problems, to be honest. So let's talk about regulated sources of information. We've already talked about the accounts. And of course, in the US, the accounting standards that are applied are US GAAP. And for most of the rest of the world, we're going to be applying international financial reporting standards. Now, a question I often get from candidates is, which one should I assume when there is a conflict between them? Basic rules for your exam are going to be, assume international financial reporting standards apply unless told otherwise in the exam. So accounting standards, of course, those are going to govern what we need to produce in terms of the accounts, what principles can be applied, etc. when we're producing the balance sheet, income statement, cash flow statement, footnotes, etc. Securities regulation, this isn't massively excited. I wouldn't lose a huge amount of sleep trying to learn the details of IOSCO, for example. Well, what is IOSCO? It's the International Organization of Securities Commissions, essentially. So this is an organization where the members are the securities market regulators of each country. I can imagine the excitement of the meetings where all the members are securities regulators themselves. But it's IOSCO. It covers about 95% of securities markets in the world. So it's a big organization spanning about 115 different securities jurisdictions. So as I mentioned, the core regulators or the core members are securities regulators. So the US member of IOSCO will be the SEC, the Securities and Exchange Commission, for example. Do you need to know much about IOSCO? I don't think so. I think you need to be aware that they set the objectives of securities regulation. Okay, so they're setting, oops, go back, get my pen up, sorry. So these guys are going to be, if I can get the pen, yes, finally, setting objectives and principles of securities regulation. I think it's worth being aware that, if IOSCO sets an objective or states a principle, it's not mandatory for each securities regulator to adopt that, okay? But really what they're trying to work on is global harmonization. But it's down to the individual members to actually adopt these principles and incorporate these principles within their own regulation. Anything else we should be aware of? I think we should have an outside understanding of the goals of IOSCO, and they're fairly straightforward. The goals are, well, what's the goal of any regulator? It's protection. And of course, we're talking about investor protection. And the idea that different investors require different levels of protection. Are we dealing with a member of the public that needs a high level of protection, or are we dealing with an institutional investor that potentially needs a lower level of protection? So investor protection is going to be key. And they're working on transparent and fair markets. So really this is talking about securities prices trying to reflect all price sensitive information. So it'll be talking about things like trade publishing. It'll be talking about the release of publicly sensitive information or price sensitive information in there. So transparent and fair markets. And the final one of their goals is to reduce systematic risk. Systematic risk, or really we're talking about global risk, and the idea of contagion. And this, of course, became very popular in 2008 in the credit crunch, and then throughout the next decade as we lurched into Eurozone crises with debt. The idea that if one bank made a loss, those losses could ripple around financial markets and cause other banking institutions to go under. Why? Well, of course, because of the interconnected nature of globalized banking these days. So the idea is reducing systematic risk, and you can think, therefore, that things like Basel agreements and regulatory capital fit into that idea as well. So that is our IOSCO. You also should be aware of the Securities and Exchange Commission, the US regulators. Now, in the CFA books, they then start to go into various forms that the SEC require. I'm going to touch on these, but in the end, I don't think they're going to focus too heavily on the exam because ultimately we're doing a international exam. And whilst it's very useful for a US candidate to know about SEC filings, for maybe overseas candidates, it's less important. So I'd have an awareness, and I'd certainly focus on knowing what a couple of them, what a few of them are. Let me get some up for you. I listed them out. So these are the required SEC filings. There are more than this. They go into what if you're a Canadian company with a dual listing on a US exchange. And you think, my God, if they're testing that in the exam, I don't want to be a CFA charter holder. Okay, I think they'll be sensible. I think if they are going to mention these at all in the exam, they're going to focus on the key ones. So I think you should be aware of registration statements. So a company is required to file a registration statement with the SEC every time it wants to issue new equity in the markets. So that could be initial public offering, or it could be subsequent offerings of new shares. So when new financial instruments are being sold to investors on exchange, then it requires these registration statements, and it's going to set out things like the nature of the instrument, risks associated with the instrument, etc. 10K is the annual review, including audited financial statements. So essentially this is going to be an annual review of the company's performance and audited financial statements, again useful for the analyst. Proxy statements. And I wouldn't worry about DEF 14A, that's the name of the filing for proxy statements, but I would be aware that proxy statements need to be filed with the SEC. Now, what is a proxy statement? These are filed before shareholder votes. So whether that's the annual general meeting or an extraordinary general meeting. Whenever your shareholders are going to vote, okay, then the proxy statement needs to be filed with the SEC, detailing what the vote is on. So very useful, therefore, for the analyst to look at the proxy statements to see up and coming corporate actions that the shareholders will be voting on. 10Q is quarterly interim financial statements that are required for US listed companies. Outside the US, often they are only required semi-annually rather than quarterly. So it's amended or slightly updated financial information on income statement, balance sheet, etc. Unaudited, I should point out, 10Q. Unlike the 10K, the financial statements in the 10K, remember, were audited. 10Q interim financial statements are not audited. 8K is one I really like. 8K is major events. Major events, we could replace that word major with material. So significant events, events that are so significant that they affect the company. It could be things like mergers and acquisitions. It could be significant asset disposals. It could be change of auditor, change of law firm that the company is using, removal or appointment of directors. So anything really major and significant to the company is reported in the 8K. So really, this is the mechanism where the company reports price-sensitive information to its regulator, to the SEC. 3, 4, 5 and Form 144, and again I wouldn't worry too much about the numbers here, but these are all to do with shares being traded essentially. What are we going to see particularly in Forms 3, 4 and 5? Major shareholdings. Now, what is a major shareholding? Essentially, you're a major shareholder if you own greater than 10% of a share class. Okay, then every time you transact, you're going to have to, or the company will have to report it in Forms 3, 4, 5 and 144. So we can see major shareholders buying and selling investments, as well as that, any corporate insiders, so any managers that are buying and selling company shares are reported in these. So we're going to see inside trades, and we're going to see major stakeholders, major shareholders in the company, and we're going to see their trades reported there. 11K is the only other one I'd be aware of, and that is details on employee stock compensation plans. So these are stock grants and stock options that are issued to the employees in the year. It would have to have details about how fair value is achieved for these stock compensation plans, things like vesting periods, things like strike prices, all sorts of stuff like that. We're going to talk about that a little bit more when we look at employee stock compensation plans, and we'll look at stock grants and stock options within that. Okay, so have a little bit aware of the SEC filings. Do we need to know much for Europe? I really don't think so. Are they going to test this stuff? Well, the European Commission is overall responsible for securities regulation, although it then delegates that down to individual jurisdictions. So the individual individual countries within the Eurozone essentially will have individual regulators that are responsible for applying the rules. European Commission is really therefore overseeing the framework that applies to all of those individual country regulators, and the level of cooperation between them. So the European Securities Commission, ESC, as we're going to refer to it, that is the body that is responsible for reporting to the European Commission. Okay, so what do they report on? Any securities policy issues that come to their attention. We also have ESMA, the European Securities and Markets Authority. This organisation is responsible for cross-border supervision. Okay, so interaction between the various regulators in each country. So I have a little bit of awareness of that, but I certainly wouldn't spend hours learning about IOSCO, learning about the SEC listings, and learning about the European Commission. I would spend a little bit of time on footnotes, however. Now, footnotes give us additional information on the amounts presented in the primary financial statements. In other words, the regulators, the accounting regulators, so the US Accounting Board and the International Accounting Standards Setting Board, they set the accounting standards, and those accounting standards give us a minimum level of disclosure that is required in the primary financial statements. What are the primary financial statements? The income statement, the balance sheet, the statement of comprehensive income, the cash flow statement, okay, and of course the statement of stockholders' equity as well. So they prescribe a minimum level of information on the face of those financial statements and then required additional information that you give in the footnotes. So for example, IFRS and US GAAP only require a one-step income statement. Now, one-step income statement allows you to combine all of your operating expenses, whether they relate to the production of goods and services or the running of the company, in one line. But if you do that, then the accounting standards say, hey, in your footnote disclosure, you are required to split out costs of goods sold and sales, general and admin expenses separately. Okay, so they're going to give us a lot more information than we see on the face of the primary financial statements. Another good example. On the face of the financial statements, we are likely to see inventory as a single figure. When we turn to the footnotes, we'll see what that inventory comprises of, i.e. raw materials, finished goods, work in progress. When we look at PP&E and intangibles, we'll see the gross cost, acquisitions made in the year, disposals, etc., accumulated depreciation, all set out. Okay. So they're going to set out the basis of presentation, how the accounts have been prepared, normally on a going concern basis, unless that doesn't look likely, i.e. the company is going to continue for the foreseeable future, and therefore they will have current assets, long-term assets, current liabilities, long-term liabilities. If you set aside going concern, you say, okay, the company is not a going concern, it's likely to be liquidated, there are no long-term assets and long-term liabilities. So they're going to set out the basis of presentation for the accounts. And then, and I think this is absolutely critical for the analyst, information on accounting policies, methods and estimates for all material items, for all material lines in the financial statement. So, for example, revenue. What accounting policy has been adopted? How are they recognizing their revenue? At what point do they record a sale? Is it when goods are dispatched to a customer? Is it when a customer actually receives the goods? How do they account for long-term contracts, for example? So accounting policies and the methods, certainly when they've got choice of different methods. So when we look at inventory, we tend to value inventory at the lower of cost and net realizable value. We'll talk more about that earlier. But how do you establish the cost of inventory? Well, for things that, if you're looking at a merchandising company, it simply buys in and then sells on goods, then you've got essentially four methods. You've got FIFO, LIFO, average cost, and specific identification. So they'll set out what method is being adopted in the accounts. And I think a really key thing for us to take away here is, look, accounts are subjective. There are huge amounts of estimates and assumptions being used to derive the figures that go into our income statements, our balance sheets, etc. Okay, so where estimates are material and significant, they are going to describe how they've arrived at those estimates to enable the analyst to look at them and say, do they look reasonable or not? Other disclosures, segmental reporting. This is really when you've got a conglomerate. In other words, a company that comprises of many different operations. Now, it might mean that each individual operation is a separate subsidiary, or it might mean you've set up on a divisional basis. Let's just have a little bit of a look at segmental reporting for a second. Here's my segmental reporting. You can see segmental reporting is required if a division is greater than 10%. Of what? Well, if a division is it makes up more than 10% of your revenue, and actually it's external revenue, so revenue to third-party customers rather than intercompany sales, 10% of your revenues, your asset usage, or your profits, okay, then separate segmental disclosure is required in the accounts. Now, this is hugely useful for the analyst because we're going to be able to analyze the profitability of each division. Is it increasing profitability? Are the divisions shrinking in profitability? How is the product mix of the company changing over time? Are the most profitable divisions expanding? Are the most profitable divisions contracting? And of course, also, how do the performance of those divisions stack up with what we're being told in the management discussion and analysis? Let's have a look at what you actually need to disclose in the footnotes on a segmental basis. So for each division that meets those requirements, and remember it's 10% of any of those three criteria, it doesn't need to be revenue, assets and profits, it's any one of the three. Now, first of all, you need to disclose the revenue from this particular division. And actually you need to disclose two things here. External revenue to third parties, so selling goods outside the firm, and also any intercompany transactions, so selling goods and services between various divisions, subsidiaries within the firm. You need to report a measure of profit. Often things like EBIT are reported here, so it could be EBIT, it could be net income, it could be earnings before tax, could be net income, etc. But it just requires a measure of profit. And again, what that measure needs to be, you'll need to look at the individual accounting standards. Measure of assets and liabilities. So typically total assets are recorded here. Certainly that is required by both US GAAP and IFRS. Liabilities typically is IFRS requirement rather than US GAAP requirement. Interest, and actually what we're talking about here is both interest receivable and interest payable. Okay, so you need to disclose that on a divisional basis. PP&E acquired on a divisional basis. Useful for the analyst because by looking at this, by looking at the acquisitions on a divisional basis, we can get a good idea about whether that division is expanding, okay, or contracting. In particular, what we can look at, if we've got a measure of profit and we've got a measure of revenue, we can look at the profit margins of each division, okay? Then we would hope that the most profitable divisions are being expanded by the company. So we can then look at PP&E acquired and say, look, is the company expanding its most profitable divisions or not? So useful information in there from the analyst. Depreciation and amortization on a divisional basis. Not sure what I'm going to do with this information. I guess it gives you an idea of the quality of the earnings. Typically, we argue that earnings are a high quality if they are backed by cash, and therefore non-cash items reduce earnings quality. Depreciation and amortization are classic non-cash items. We'll talk more about that when we look at cash flow statements. Notice any other non-cash expenses will need to be disclosed. It's actually, whilst it says non-cash expenses, it's also any non-cash gains that you might have as well. So non-cash expenses, things like defined benefit pension expenses, things like gains and losses on asset disposals, etc. There's a whole list. We'll talk more about it in a later module when we look at cash flow statements. And then finally, notice income tax expense split on a divisional basis. So useful information for the analyst because it gives us the ability to dive down on individual divisions of the company and look at how they are performing. And of course, that's really important if we're going to start forecasting. Okay, so I've talked about segmental reporting. Significant acquisitions and disposals, those are going to be reported in the footnotes. Important to be aware that certainly in a group accounts, a set of group accounts, if you've got major acquisitions and disposals of subsidiaries, it dramatically reduces comparability with prior years, because essentially what goes forward is not what has happened in the past, because you've either acquired a new subsidiary or disposed of a subsidiary. So a lot of information is going to be disclosed in the footnotes to enable the analyst to try and understand how these transactions are going to affect the company going forward. It's not actually just acquisitions and disposals of subsidiaries, but also major assets as well. Major disposable assets would be disclosed. Any financial instruments and risks. So these are financial instruments that the company has issued. Really what I'm thinking about here is debt, derivatives, that kind of stuff. So in other words, we're going to be describing in the footnote disclosure what it is. So in other words, if you're looking at debt, it would be a description of what the bond is, its maturity dates, its coupon rates, its periodicity on there. It would describe its risks, so maybe some scenario analysis looking at how the value of the balance sheet debt is impacted by, or how the market value of the debt is impacted by interest rate exposures. Certainly, of course, when you're looking at banks that not only issue these the items but also buy these items, then we're going to see it for both assets and liabilities. Risks and sensitivity, of course, are going to be very important when we start to look at banking institutions. Post-balance sheet events, these are really just any event that has occurred after the balance sheet date but before the accounts are published. Now, it's not going to be every event that has occurred in that period, but it's going to be significant material events. A material event. What is material? What does it even mean in the world of accounting? It means an event that is so significant that it affects the perceptions of the users of the accounts. So if there's been any post-balance sheet events that dramatically would affect the users of the account's perceptions, such as the loss of a major customer or the acquisition of a new subsidiary, etc. Those are going to be described in post-balance sheet events. And then finally, we have related party transactions. These are any transactions between the company and corporate insiders, i.e. managers and employees. There's always a danger when we look at transactions between the company and corporate insiders that they are not on proper commercial arm's length terms. You know, so for example, I'm the director of a company. The company owns some rather nice motor vehicles. I think I'll sell one of those motor vehicles to myself for $1. Well, that's clearly not commercial arm's length terms. So therefore, every time there is a transaction between the company and corporate insiders, it needs to be listed. Details of that transaction. You know, so for example, in my car example, it would be what was the car, what was its fair value, what was it actually transferred to the director for, etc. All designed so the users of the accounts can establish, look, are these transactions on a proper commercial arm's length terms? So here's our management discussion and analysis that we mentioned a little while ago, our MD&A. MD&A tends to be a US phrase. You're going to see management discussion and analysis outside the US. It just doesn't get the phrase MD&A outside the US. I think what you need to take away here is what this is the company directors really reviewing what's happened to the company in the year and what's likely to be happening going forward. So it's a kind of a review of the company. And what you should also be aware of is it is not strictly audited. Okay, so the auditors do not check the accuracy of this. So therefore, there's always going to be a suspicion potentially of bias. Even if it's not terrible bias, the company is always going to want to reflect things in the best possible light to its shareholders. Oh yes, this division made a loss during the year, but that's because we were restructuring and we think the future's going to be bright, that kind of thing. Now, the International Accounting Standards Board and the ISAB and the US GAAP have issued a practice statement about the contents of MD&A. Notice it talks about the nature of the business, should be included. So these are your various business operations. What are you doing? What are your core business operations? Management's objectives and strategies. So the objectives for each business division, the strategies that the company is following to achieve them. Very useful, because of course what we can then do as an analyst is look at the ratios that we compute on the current balance sheet, income statement, etc., to see, look, does it look like they are meeting their objectives? Significant resources available to the companies, risks and relationships. So significant resources are the resources available to the company. It's infrastructure, so PP&E and intangibles, but of course as well cash flow. Because remember, we've said cash flow gives us flexibility to respond to new events, if you like, opportunities, and of course risks. Significant risks that the company is facing. So it might be, for example, that there is some government regulation that might be passed that will essentially massively affect the business going forward. So maybe some environmental legislation that's going to affect the company. So for example, in Europe, we've got the shift to electric vehicles and ICE engines, so internal combustion engines, being phased out over time. And of course, that's government regulation, and it affects massively car manufacturers in Europe. So things like risk, government regulations changing, but also other risks that you're exposed to. So not just government regulation, but economic factors, social factors, technological factors. And of course, as well, significant relationships. In particular, this is relationships with customers. In particular, we're very interested here if we're over-reliant on one particular customer. So customers, suppliers, but also the providers of capital. And that includes, of course, financial institutions, our bankers, our bondholders, etc. Now, the results of operations is just really a kind of review of the year on a divisional basis. So what they'll do is they'll go through each division and they'll talk about how it performed, why it performed like that, what was it exposed to, what economic, social, technical factors was it exposed to during the year. And notice that it should also include critical performance measures. Okay, so critical performance measures, key performance measures, in other words, critical performance measures that tell us whether the company is meeting its objectives or strategies. Now, of course, the analyst is going to be computing a lot of these themselves via ratios, but we're expecting some to be given in the MD&A. Notice as well, it says it should include favourable and unfavourable trends and events impacting liquidity. Okay, now liquidity is our ability to cover our short-term liabilities as they fall due. We're going to look at key liquidity ratios such as the current ratio, the quick ratio later. We're going to be interested in capital resources. So, of course, capital resources are looking at our long-term solvency, long-term debt to equity blend. Capital resources, the ability to raise finance, of course. And then finally, our operating results. And our operating results, well, you could really flick that back to results from operations. How has each division performed during the period? What other information do they disclose in the MD&A? Information on inflation, changing prices, material events, and uncertainties that will affect future operations. Okay. Contractual obligations that the company has, i.e. if it's contracted to purchase something, maybe purchase an asset, purchase a subsidiary in the future, those will be detailed. And I think this is an important one, although we haven't got it on the list here, discussion of material accounting policies and significant estimates. Now remember, we said we saw that, we see them being disclosed in the footnotes, but we'll also see them being discussed in the management discussion and analysis, particularly if there has been a change to accounting policies and estimates during the period. It should be explained, why has there been the change? Why does the company feel that this change is going to better reflect the economic substance of a transaction? Right, quickly on to the audit report. Quite useful stuff this. Nice simple questions in the exam. Now, of course, this is all to do with agency risk, the idea that the shareholders own the company, but the directors run the company, and for big companies, the two are not necessarily the same. For smaller owner-managed companies, of course, that's not such a big issue. So there's always the risk that we incur agency costs. This is when the directors do something that doesn't maximise shareholder wealth. So as a result of that, we need to make sure there is an independent review of the company's financial statements to make sure those accounts are true and fair. True, they essentially follow the required accounting standards. Fair, they are free from material errors. So it's an independent review. The auditors are appointed by the shareholders, not the directors, kind of. The shareholders typically vote the auditors in. The directors typically recommend the audit firm, and it's typically done at either an AGM or an EGM. Okay, but the auditors are going to come in. They report to the shareholders on the company's financial statements. An unqualified audit report, and this is what all companies are hoping for, gives the shareholders reasonable assurance. Okay, reasonable assurance that the financial statements are free from material errors. So what the auditors are not saying are these accounts are accurate to the nearest dollar. What they are saying is that we've conducted our audit to give reasonable assurance that they are free from material errors. What's a material error? Well, remember, it's an error so significant that it would affect the perceptions of the users of the accounts. Who chooses materiality? Well, the audit firm. Reasonable assurance just means they're not checking everything. Typically, they use sample processes within the audit. You do need to know the different audit opinions. Unqualified. This is what every company is hoping for, because this is the auditors saying these accounts are true and fair. In other words, they do reflect the economic substance of the company. The balance sheet reflects position. The income statement reflects performance, etc. Now, we need to be aware of certain modified audit opinions. Qualified, first of all. This is sometimes known as an except for audit report. What the auditors are saying is the accounts are true and fair except for, and then they will tell you what they disagree with. Normally it's how a particular transaction has been accounted for. The auditors might disagree that the accounting methodology results in economic substance of the transaction being reported. So they might issue a qualified audit report where they say, hey, look, these accounts are true and fair except for this item, and then they go on to detail it. Now, what I should say as well is during the audit, if the auditors discover material errors or things they disagree with, they do give the company the opportunity to adjust the accounts and get an unqualified audit report. So qualified audit reports would only be where the auditors disagree with accounting treatment of a particular item and the company refuses to amend it. Now, adverse, this is more significant than qualified. Remember, with qualified, we're saying true and fair except for how this has been accounted for. Adverse, the auditors here are saying, no, these aren't true or fair. In other words, they're riddled with errors, whether it's incorrect accounting principles being followed that don't reflect economic substance, resulting in material errors. Okay, so it's more than just one transaction we're saying here. Really, you can't rely on these financial statements. So adverse is massively significant for a company. And then finally, disclaimer of opinion. This is the auditors saying we couldn't collect enough evidence during our audit to establish or to verify, form an opinion on the amounts included in the financial statement. So that's a disclaimer of opinion. Good. Now, as well, under Sarbanes-Oxley in the US, the auditors also must provide an opinion on the company's internal controls. Not required outside the US typically. Now, standard auditor's opinion, what do they produce? And you'll see this sitting in the financial statements. It will be in the financial statements. What it does is it sets out the responsibility of management to prepare the accounts. Why? Well, because shareholders often incorrectly assume that the auditors produce the accounts. They don't. The auditors just verify the accounts, if you like, or the auditors check the accounts to ensure that they are free from material errors. It is the company's management's responsibility to prepare the accounts. Obviously, they delegate that to their accounting function, etc., but it's their responsibility. It will also set out the independence of the auditors, the fact that the auditors are not beholden to the management of the company, they actually report independently to the shareholders. It will then set out whether the accounts have been properly prepared with the relevant GAAP. Remember the two GAPs that we see. GAAP stands for Generally Agreed Accounting Principles, and the two ones we have are US GAAP and IFRS in our exam. So properly prepared with the correct accounting standards, they follow the correct accounting standards and are free from material misstatement, free from material errors in the accounts, free from either omissions or misstatements of amounts, or if you like, accounting principles that have been misapplied so that the figures in the accounts don't reflect the true economic substance. Okay, so free from material misstatement. And accounting principles and estimates chosen are reasonable. Now, again, remember we've said already, and we're going to see lots of situations where the company has to make estimates in order to arrive at the figures to include in its financial statements. But it's vital where there is subjectivity that the auditors review how these estimates have been made and check they are reasonable, that they are going to result in the economic substance of the transaction being reported. Okay, so they also highlight key or audit matters. So it will highlight where significant judgments or estimates have been made, and it will also account or talk about how significant transactions were accounted for, okay? And also notice choices the auditors believe have significant likelihoods of being misstated. So in other words, risks. The auditors will point out where the risks in the financial statement, where the subjectivity in the financial statement is. Right, our last little bit here is looking at differences between IFRS and US GAAP. Convergence projects between the International Accounting Standards Board and the FASB in the US have resulted in a convergence of these. Now, differences though, US GAAP typically is rules-based. In other words, they set out the rules about how you will account for each transaction. IFRS has more flexibility. It is principles based. What IFRS does is it sets out the principles that you should apply to ensure that economic substance of transactions is reported in your accounts. Okay, and again, if you look at the prerequisites, there's a big reading on IFRS 1, which actually sets out the framework of these principles. So US GAAP, very much rules based. Now, of course, the danger is rules can be broken. So US GAAP doesn't have a lot of flexibility in it, okay? And it has resulted in the past in companies applying the rules correctly, but not actually reporting the true economic substance of transactions. Enron is a classic example of that, essentially, where it had all of the risks and rewards of the special purpose vehicles it created, but did not include them in the financial statements. Made sure it was a minority shareholder, essentially. Okay, now under IFRS, because it's principles based, you tend to always go with what the true economic substance of the transaction is. And that sounds great, doesn't it? But that means there's judgments and subjectivity in IFRS, or greater judgment and subjectivity in IFRS. And of course, that means companies could potentially choose an accounting treatment that doesn't report the economic substance. So kind of pros and cons of both. What else have we got? Interest paid. We're going to see this in cash flow statements, so I wouldn't worry about it right now. US GAAP with interest paid is very prescriptive. It says always treat it as a cash flow from operations. Whereas IFRS says, well, it depends really when you're looking at interest paid. Are you a bank? Because paying interest on customers' deposits would be part of your operations, so treat it as a cash flow from operations. Or are you not a bank? Are you not a financial institution? In which case, paying interest is not part of your operations, it's part of how you finance the company, i.e. its capital structure, so we'll treat the interest payment as a cash flow from financing. Same with interest received. Notice US GAAP says treat it as a CFO always. IFRS says, well look, Is receiving interest part of your business? Again, if you're a bank, if you're a financial institution, it probably is, in which case you'll treat it as a CFO. If it's not, it's incidental to your core operations, then treat it as CFI. Inventory valuation, well, US GAAP is going to allow us to use LIFO, FIFO, average cost and specific ID. IFRS allows all of those except LIFO. Last in, first out. Don't worry about it too much. We're going to talk about inventory in a later module. Development costs. So we're talking about R&D here, research and development. US GAAP and IFRS are consistent with research. They both say expensive. But development, and what's the significance? What's the difference between research and development? Well, research is more speculative in nature. Development is actually developing a product that you think is going to be launched. Well, US GAAP says even development costs should be expensed because we don't know whether the product will be launched. We don't know whether it will be a success. In other words, we don't know whether it will have the benefits to match those costs against in the future. IFRS says you can potentially capitalize development costs according to a set list of criteria. And all those criteria are designed to do is look to see whether the product is going to be launched and whether the product is likely to be profitable. In other words, are there going to be future benefits to amortize these costs against? We'll look again against development costs in a later module in more detail. Reversal of inventory write-downs under US GAAP. It's prohibited. Under IFRS, it's allowed. So the rules potentially here are we have to hold our inventory in the balance sheet at the lower of cost and net realizable value. There are some other rules that apply to US GAAP, but we'll look at those later. So in other words, if net realizable value has fallen below cost, you have got a write-down. So you have to write your inventory down to net realizable value. But what if net realizable value then goes above cost? Well, IFRS is allowing you to reverse it. US GAAP is not. Generally speaking, the same is true of impairments. Now, impairments are like write-downs of long-lived assets, PP&E and intangibles. IFRS typically allows you to reverse impairments. US GAAP typically does not. Although there are some situations when US GAAP does allow you to reverse impairments, and that's impairments on assets held for disposal rather than assets held for use. I wouldn't get too bogged down in that. We'll talk more about that when we get to impairments in a later module.